You've Googled it at 11 p.m. You were too embarrassed to ask your real estate agent. You assumed the answer was no, so you never even asked the question. This video is for every mortgage question you've been sitting on. I'm Candy Williams, a mortgage loan officer, and today I'm answering the 8 questions buyers are too afraid to ask out loud. No judgment, just real answers. Because there's no such thing as a dumb mortgage question, but there are expensive assumptions. Before we get into it, if this is the kind of content that actually helps you, hit subscribe right now. I put out mortgage content every single week, and I don't want you to miss out on what's coming next. I'm going to answer 8 questions today. These are the questions I hear most often from buyers who almost didn't reach out, the ones who assumed the answer would be no before they even asked. We're going to cover debt, self employment, past credit issues, gift money, appraisals, down payments, student loans, and credit scores. By the end of this video, you're going to have a much clearer picture of where you actually stand. Question one, do I have to be debt free to buy a home? Let's start with one of the biggest misconceptions out there, the idea that you have to be debt free in order to purchase a home or to qualify for a mortgage. You don't. And honestly, most buyers I work with aren't debt free. Here's what lenders actually look at it's called your debt to income ratio, or your DTI. That's the percentage of your gross monthly income that goes towards your monthly payment. So if you make $6,000 a month before taxes and your monthly debt payments, car, student loans, credit cards, the new mortgage add up to $2,400, your DTI is 40%. Most loan programs have DTI limits somewhere between 43 and 50%, depending on the loan type and your overall financial profile. The key word there is ratio. Lenders aren't looking at how much debt you have in total, they're looking at how manageable it is relative to your income. Student loans, a car payment, credit cards, none of those automatically disqualify you. What matters is the ratio, not the balance. Question two, can I buy a home if I'm self employed? Yes. And this is a big one because a lot of self employed buyers assume that being their own boss makes them unqualifiable, and it doesn't. It does mean more documentation, though. So for run of the mill employees, lenders look at your pay stubs and W 2s. For self employed buyers, lenders use the last 2 years of tax returns to calculate your qualifying income. We're averaging it out. So consistent or growing income is what we want to see. Here's where it gets tricky. If you write off a lot of business expenses, which is smart tax strategy, your taxable income on paper may be lower than what you actually bring in. That lower number is what lenders use. So if you're self employed and thinking about buying in the next year or two, it's worth having a conversation with both your accountant and your lender before tax season so you can plan strategically. 2 years of self employment history, consistent or growing income, and solid documentation. That's the formula. I work with self employed buyers regularly, and it absolutely can be done. I do want to add a little note here. There are options for those buyers whose tax returns don't reflect their buying ability. There are special loans for them, but they do have higher down payments and interest rates. Question three, can I buy with a bankruptcy or a foreclosure in my past? Yes, after a waiting period. And I want to be really clear about this because I think a lot of people assume a bankruptcy or foreclosure is a permanent door closing, and it's not. It's a timeline. For FHA loans, if you've gone through a bankruptcy, the waiting period is 2 years from the discharge date. If you've gone through a foreclosure, it's 3 years from the completion date. For conventional loans, the waiting periods are longer, typically 4 years after bankruptcy and 7 years after a foreclosure, though there are some exceptions that bring that down to 3 years under certain circumstances. The clock starts from your discharge or your completion date, not from when it happened. So if your bankruptcy was discharged 3 years ago, for FHA purposes, you've already cleared the waiting period. What happens during that waiting period matters too, though. Lenders want to see that you've rebuilt your credit and you've demonstrated financial responsibility since then. It's not just about waiting, it's about what you do while you wait. If you're in that window right now, let's talk about what's to focus on so you're in the strongest possible position when the waiting period ends. Question four, can I use gift funds for my down payment? Yes, on most loan types. And this surprises a lot of buyers, but it's something we're seeing more and more of. FHA loans, conventional loans, VA, and USDA loans all allow gift funds for the down payment as long as the gift comes from an eligible donor. For most programs, that means a family member, a parent, a grandparent, sibling, or spouse. Sometimes someone with a family-like relationship will also work. There are two main things that the lender is going to need: a gift letter and documentation of the transfer. The gift letter is a signed statement from the donor confirming that the money is a gift, not a loan, that they don't expect it to be paid back. The lender will also want to see a paper trail, the transfer from the donor's account to yours. Talk to us before any money changes hands so we can tell you exactly what is needed. We'll try to make it as simple as possible for everyone involved. One thing to be aware of: Some conventional loan programs do require that you contribute a portion of the down payment from your own funds, depending on how much you're putting down and the type of property that you're buying. We'll walk you through the specifics for your situation. But the short answer is yes. If your family wants to help, there's almost always a clean way to make that happen. Question five: what if the home doesn't appraise for the purchase price? This is one that catches buyers off guard, especially if it's the first time they're purchasing a home. But it's not the catastrophe that it might feel like in the moment. Here's what happens: the lender orders an appraisal to confirm that the home is worth what you're paying for it. The appraiser comes back with a value that's lower than the purchase price. You have a gap and you have options. Option one is to challenge the appraisal. If you and your agent believe the appraiser missed comparable sales that support the higher price, you can request a reconsideration of value. It doesn't always work, but it's definitely worth exploring. Option two is renegotiate the price of the seller. This is the most common outcome. The seller may be willing to drop the price to the appraised value or meet you partway. Option three is pay the difference out of pocket. If you have the cash and you love the home, you can make up that gap between the appraised value and the purchase price yourself with additional funds. Option four is to walk away. If your contract includes an appraisal contingency, and it should, you can walk away and get your earnest money back. The key takeaway is a low appraisal is a negotiation moment, not a dead end. Your agent and your lender should both be in your corner helping you figure out the best path forward. Question six: how much do I actually need for a down payment? This is probably the question with the biggest gap between what people think the answer is and what it actually is. Most people have that 20% rule stuck in their heads, and I get it. That number has been floating around for decades, but it is outdated and it is keeping people on the sidelines who could be homeowners right now. Here are the actual minimums by the loan type. FHA loans, 3.5% down with a credit score of 580 or higher. Conventional loans as low as 3% down, depending on the program. VA loans, 0 down for eligible veterans and active duty service members. USDA loans, 0 down for eligible buyers in qualifying rural and suburban areas. Let me put that in real numbers. On a $250,000 home, 3.5% down is $8,750, not $50,000, not $30,000. And if even that feels like a stretch right now, there are down payment assistance programs specifically designed to help bridge that gap. We're going to be talking about those in depth very soon. The 20% myth has cost more people homeownership than almost any other single piece of misinformation. Question seven: will my student loans stop me from buying a home? Not automatically. And I want to be very clear about that because I talk to buyers every week who have put off homeownership for years because they assume their student loans would disqualify them. There's a lot of noise in the media about this lately that's causing confusion. Student loans factor into your debt to income ratio just like any other monthly debt. They are one piece of the puzzle, not the whole picture. If your loans are in active repayment, we use your actual monthly payment in that debt to income calculation. If your loans are in deferment or forbearance, or your credit report shows a payment of 0 monthly, then this is where it gets a little more nuanced. We'll calculate a payment based on the loan type. For most loan types, the calculation is 0.5% of the balance, but there are some variations on that calculation for other loans. Here's the bottom line: having a student loan doesn't disqualify you. What matters is the full debt picture relative to your income. The right loan type and a well structured file can make a significant difference. I've helped buyers close homes with very significant student loan balances. It comes down to the math and sometimes to choosing the right loan program for your situation. Question A: what credit score do I actually need? So let me give you the actual minimums because I think a lot of people are operating under the assumption that they are much higher than reality. And we don't look at the score alone, we're looking at the content of the credit. So you can meet these minimum credit score requirements and still not qualify for the loan just yet. So on an FHA loan, 580 for 3.5% down. If your score is between 500 and 579, you can still qualify with 10% down. Conventional loan, it was recently changed so that there is no minimum score, but most people will find it difficult to qualify with a score under 620. And honestly, the best interest rates are going to be for over 720 scores. And you might still find some lenders that have their own minimum requirements. VA loan, there's no official government minimum, but most lenders want to see 580 to 620. USDA loans typically 640 and above. So the range for qualifying is 580 to 640 depending on the loan type, not 700, not 750. Now, does your score affect your interest rate? Yes. A higher score gets you a better rate, and over the life of a 30-year loan, that matters. But the idea that you need an 800 to even qualify is simply not true. And if your score isn't where it needs to be yet, there are real concrete steps to move it, often faster than people expect. 90 days of focused effort can make a meaningful difference. I want to take a moment before we wrap up and share a story that I think ties all of this together. I worked with a buyer, let's call her Jasmine, who had been sitting on these exact questions for almost 3 years. She had student loans. She had some past credit issues that she was embarrassed about. She had been renting for 6 years, and she had convinced herself completely on her own without ever talking to a lender that homeownership just wasn't for her yet. Not because she didn't want it, she wanted it more than anything, but she had built up this whole story in her head about why the answer would be no. When she finally reached out to me, the first thing she said was, I just want to know if it's even possible. I'm not expecting you to say yes. And we sat down and looked at her full picture together. Her DTI was actually manageable. Her credit score was a 612, not perfect, but workable. She had some savings. She qualified for an FHA loan. She needed about 90 days of focused credit work to get her credit score where we wanted it. We made a plan. She executed it 6 months after that first conversation. 6 months after she almost never picked up the phone, she had keys in her hands. The most expensive thing she almost did was never ask. Whatever question you've been sitting on, whatever assumption has been keeping you from starting the conversation, that's the thing I want you to question today. If any of what we covered today resonated with you, if you heard yourself in any of those 8 questions, that's your sign to take the next step. Click the link in the description below, and I will personally send you the free Homebuyer Guide. It covers everything you need to know before you start the process: your credit, your income, your down payment options, what to expect from the application through closing. No sales pitch, no pressure, just real information. And subscribe if you haven't already. I put out mortgage education every week. You don't want to miss what's coming next. Thanks for watching. I'll see you in the next one.